Hello and welcome to Pro Trader Strategies market commentary for Tuesday, November the 26th. My name is Eric Wilkinson, and yes, you may very well recognize me as the Wolfman from mainstream media. I'm here to not only talk about the economic data and how that affects the overall markets, but options and how to implement those options into our portfolios to increase our yield in that portfolio and our probabilities of success. One thing to keep in mind, though, is past performance of any trading system or methodology is not necessarily indicative of future results. All right, with that out of the way, let's get it on with that economic data. And it is a little bit light today. Tomorrow is going to be the bigger day for economic data, so we'll definitely be on cue for that. Most of that's because of the holiday here in the United States on Thursday. It's Thanksgiving, so many of the economic data points that would come out on Thursday are going to be pushed to Wednesday. So tomorrow is a heavy day for economic data, so we'll look forward to that. Without further ado, though, let's talk about here in the United States, because not a whole lot happened across the pond. We got our trade balance coming in better than expected at 66.5 billion, negative 66.5 billion, expected to be negative 71 billion. You know, a lot of that has to do with the tariffs. We're seeing that trade balance start to twist into our favor based on those tariffs. So that is a good thing, despite the fact that I don't necessarily believe in tariffs in general. They just don't seem to be affecting the economy as negatively as I would have expected. Anyway, preliminary wholesale inventory is coming in at 0.2%. That's in line with expectations. If you remember last month, we saw a big, or not quite as good of a dip. This one was revised to negative 0.4, so that is better than what was expected at, I believe it was just negative 0.3, so just a slight revision there. One thing to note with the wholesale inventory numbers, it really has to do with the manufacturing, and we've talked about that. Just because they're moving inventories doesn't necessarily mean it's good for the economy. It's good for those businesses because they're getting rid of inventory, but if they're not producing, then that isn't good for the economy. It's a bit of a fake out in a sense. It's good for the company, but it's not necessarily reflective of what's going on in the environment or in the economic environment. All right, and that shows up in Richmond Manufacturing Index, and that came in at -1, expected to be a positive 6. Last month's number not revised at all, but anytime we get those negative numbers, that is a sign of weakness in the economy, and that's showing up there. We also saw consumer confidence waning in the CB consumer confidence, which is the conference board. It's one of the more important ones. We talk about University of Michigan consumer sentiment, and that is a consumer confidence type indicator. This one's definitely more important, and it came in at 125.5, expected to be 126.9. So like I said, it came off a little bit there. We did get a nice number in new home sales coming in at 733,000, expected to be 708,000. Last month's number was revised up from 701,000 to 738,000. So people are coming off of the sidelines and actually getting in there buying homes. That has to do with these lower interest rates that we're seeing here, and that is good for the overall economy. People should be thinking about buying homes at this low levels for their interest rates, because they're not going to, the next couple of steps, even if the Fed does lower by a 1/4 percentage point or something along those lines, it's not going to really affect the consumer as much. It's going to help out the businesses a lot more. But on the consumer side, in the new home sales, I think we've gotten that move, and it is a good time to be looking to buy a house if you have bought or refinanced if you missed out on that opportunity now that it's starting to come down. And we also have Bernard speaking later on today, actually probably right about now in about 5 minutes. All right. Let's talk about the overall markets. We've got crude oil just slightly moving higher. It's gotten above that $58 a barrel and settled above there. Now, we've talked about that as acting as resistance, and that resistance has held true. We haven't been able to break above that for several months. We've tested it, but always pretty much come back down almost lockstep, aside from maybe last Friday or something. But we are now starting to look like we're toggling in between that $58 a barrel and the $59 a barrel, and then we've got $60 right there. So all of those are going to be overhead resistances. I don't think, especially with that manufacturing number out of Richmond Fed, that should show weakness in the manufacturing sector. They are the biggest driver of this market. It's not just you and I buying or driving cars and the gasoline. Distillates is another component of that, breaking down the crude oil into different manufacturing aspects. A lot of it goes into polypropylene, plastics, and then others go into our gasoline, aviation fuel, stuff like that. So I'm expecting crude oil to start coming back off. I mean, I've been out of it for a little bit, but you know, we've gotten in this trend channel here, and I do expect us to come back down and at least test the point of control right here, where the most time and volume's been spent. That's going to act as a magnet and try and draw this market down. Now, I even talked about, especially with the way the economy is going, is to come back down here to this $55 a barrel area and fill in that volume, that low volume area, build out a nice big bell curve. Now, we are starting to push higher and higher towards that 60s. I don't think that that's sustainable at the pump. It's going to drive prices up, and it's going to cause people to even use their cars a little bit less, maybe not take a vacation or something along those lines. Maybe not quite that dramatic, but at the end of the day, it does slow down on velocity of money and hurts the overall economy. Now, something we're seeing here, all-time highs in the equities, but we're seeing crude or gold futures start to drive a little bit higher here. And this is starting to send me a little bit of a signal that I think that gold is going to start going back up there and approaching that 1,500 a troy ounce mark. That being the weaker dollar, that should drive gold higher as the economy weakens a little bit. If we see the economy start to weaken a little bit, then that should also be a flight to safety for the precious metals. That's a safe haven type of instrument. If you remember, I sold some calls in there. I actually sold some puts, and then we got the market moving in the wrong direction for me and got out of those nicely. Now I flipped it around and sold some calls on the 15th of the month, if you remember, which was right around here, 15. Where's 15? Right there. 15, I sold some calls in GLD. We'll talk about that here in a minute. And that was for a bit of a bearish. So I've gotten that move over the hump, came back down, tested 1450. That's where I said I think we're going to find some support and see a bit of a rebound, maybe even test the value area high here, which lines up very closely with that 1500. I mean, it's basically 14. It says it's 1493 or something right there. That is where I think we're going to test. And then, you know, right above that is that nice volume node where I think that that is where the market is going to build out and move this point of control, which is way down here, higher. I think that point of control is going to shift towards 1500. It might not happen by the end of the year, but I do think that that is a almost foregone conclusion going forward. Another thing, we're seeing bonds move higher here, back towards that 160 handle. You know, we're just basically a couple of ticks shy of that. That lines up with my Fibonacci here on the extensions. I expect us to hang out in and around that 160 handle for quite some time, actually. You know, we might overextend to the upside and to the downside like we did down here, but the fact of the matter is I think that we are going to stay within, maybe say, let's call it that area, maybe even just slightly higher on that bottom line there, and stick around there, because I think that the Fed is going to be more cautious and lean towards easing than they are raising rates. They're under pressure by just about everybody with this global mandate of lower interest rates. I don't know that we need to go much lower than where we are right now, but a little bit lower would be a sign of good faith towards the rest of the global economies, because as they struggle and our interest rates are higher, it really drives their money towards us, and I don't think that they necessarily want that at this given time. We're seeing a bottoming happening here in the VIX, which is expected. We are at extreme lows in VIX right now, as you can see right here, even if just looking at the chart. That once you get into that 11 handle, that's where we're starting to see some bottoming happen in the VIX. That chart setup right there, you know, the VIX chart setups are pretty good to look at. I don't know that they necessarily follow regular candlestick type patterns, but if you look at that right there, it looks like we are looking for a bottom and maybe have the market start to trend higher, despite the fact that we have a crossover in the simple moving averages there. But let's take a look at the Dow Jones Industrial Average. You can see here it's up 34 points on the day. That is a new all-time high because that's intraday. And that pattern at the top there, we look like we were getting a bit of a tweezer top almost from here to here on those 2 days, today and a few days ago. Now, I've talked about this. I think we're getting a little overextended in equities. I'm looking for a bit of a more of a rollover, maybe even test back down in and around this 27,377 area. That maybe even bringing us back down into this value area in and around here. Now, I don't think we're going to go down and touch the point of control down here necessarily. I think that we're going to stay above that. I think the economy is doing rather decent, and with the thought that there might be lower interest rates coming forward or down the pike, that could keep us elevated. But this seems very tight wound. We are in a trend channel here, but I do expect us to break below that trend channel, maybe going into next week and heading into the holidays. A lot of that will have to do with people signaling what kind of traffic's going on at the retailers during the holiday season. Black Friday will be a big indicator of some of that as well. So we'll keep our eyes out for that. But again, we can see that the NASDAQ has created an all-time high, but it's stuck in that trend channel. This chart pattern at the top, anytime we get those spinning dojis like that, then that starts looking a little bit toppy after a big move, especially where we've gotten that, we've gotten that chart set up. Now, tomorrow, if we start seeing confirmation to the downside, then that would kind of signal that we are starting to get a little bit more toppy, I think, and maybe coming down, test this area right here at around 81.65 and possibly even the point of control. And the point of control, as you can see, lines up with 8,000 there and the 50-day moving average. So we've got the 50-day right there. I think that the market is looking to break below that. We'd talked about once we broke below right there, that 9-day moving average, that was going to signal short-term bearishness. Now we got the next day just to break above that, right lockstep with when I was talking about. I think we're going to see that market start to trend down. Yesterday, a settlement above that kind of broke that pattern for us, and could be out the window for a few days anyway. Again, we're looking at the E-mini S&Ps creating an all-time high here. It's 31.45, but if we take out the overnight session, we will see we still have an overnight high, or an all-time high, I should say, 31.3775. That again, pulling it out, it still looks a little toppy here in this tight little range. We are seeing volumes kind of slough off a little bit, but I'm expecting this, like I said, this market to start rolling over rather soon. You can see here on the 30-minute chart with the overnight session in gray, the day session is in black, that we got that big spike up to 31.45. That is an all-time print for the E-mini S&Ps, but again, we are going to probably discount that and look to revisit that. I don't know if it's going to happen, though, anytime soon. I think that we might actually see this market roll over a little bit. Might not roll over as far as what I was expecting, though, because the market's going to have that in its mind that it needs to revisit that number and print it during the day session. So next week we might see a slight rollover here in the equities where we come back down just a little bit. Maybe we'll test this point of control here and then rebound back to test that 31.45 area. All right, so we're going to keep our eyes out for that going forward. Now let's talk about a couple of things that I've been looking at. GLD, hear me talking about, I'm getting a little worried. We're seeing gold move higher here, even though equities are moving higher. But to me, it feels like it's maybe more of a roll into gold, as maybe some of the institutional investors are starting to roll that money over into a little bit more of a safe haven, locking in some of those profits from the year, right? With those guys that are running hedge funds and different types of funds are going to be trying to lock in some of their profits heading into December, so that their year-end statements look rather well, and we could start seeing some of that shift start to happen the rest of this week and going into next week. So we're going to have to keep our eye on that. That's why I was talking about with GLD, I had sold the December 144 calls in there for 44 cents, and that landed on the 15th, which was right there on that little down dip right there. So on the 15th, which was lining up right around here, I sold the calls, and like I said, I sold the D's 144 calls. Sold the D's 144 calls for 44 cents, and usually I look to get out of that at about 50% of my max profit, but you can see the market rolled over, and I also got volatility coming out. Sorry, let's just do it like that. Vol coming out. And vol goes down, that helps out our premium, and I was able to get out of that trade for 15 cents today. I actually paid up on that. The market was starting to come off a little bit. We had those highs in the equities, and as soon as I saw us not really go and try and print those all-time highs in the day session for the NASDAQ and the E-mini S&Ps, and this rebound starting to happen in GLD, I thought it would be better to be safe than sorry, and ended up covering those for slightly better than 50% of my max profit. So a nice little win on that trade. Been playing gold like a fiddle, like Charlie Daniels fiddle. All right, that's about it. That's about all I've got for you. We are getting a bit more of a rebound happening in McDonald's. I'm keeping my eye on that. We're stuck in a bit of a trough here, building up a big volume node. Hopefully I can see, I'm looking for the point of control down here to shift higher and at least get to this 195 area. If you guys remember, I went in and sold the 185 puts in here, so I'm short the 185 puts that I'm going to be dollar cost averaging, because I am long at 200 here. Oops, I'm long at $200 in McDonald's, so I sold the 185 puts in here. So if we come back down there and test that point of control, I'm going to be happy to add to my position dollar cost averaging, right? And if I don't go down there and revisit it, I've lowered my cost basis on McDonald's quite a bit, actually. I think I've lowered it by about $1, so my break even on McDonald's right now is right around 198 from doing that, selling calls against it, selling some puts in there as well. I sold some puts in there earlier on, covered those for a nice profit. Then once we got that bit of a dip, I sold some more puts in there, because I'm still on the mandate that I'm going to dollar cost average, especially if we can get this point of control to shift higher. Then that, my break even will then be just slightly below where the point of control is, a little bit higher than us. So I'm still bullish McDonald's. They're coming out with their own Beyond Meat as well, which is a plant-based substitute for the meat hamburger, and I think that this is just a little bit overdone to the downside. McDonald's is not going to go anywhere. So that's about it. Sorry I ran a little bit long today. I'll let you guys go, other than check out tomorrow's webinar. Since Thursday's the holiday, we're moving that webinar up to from Thursday to Wednesday. It's going to be a really great one. We come up with our bearish directional bias, and then find the best strategy for that bias. All right, so if you can't take that, take it easy.